Short-term rentals are one of the best tax strategies for real estate investors if you do it right. But make just one mistake and it could cost you thousands of dollars in tax savings, or worse, land you in an audit with the IRS. In this video, I'll break down the 7 most critical mistakes that short-term rental investors make that could cost you big. If you're investing in Airbnbs or VRBOs, you cannot afford to miss this one. Stick around to the end because I'm going to be sharing a pro tip that even some tax professionals get wrong. It could mean the difference between keeping your deductions or losing them completely. All right, mistake number 1, misunderstanding the short-term rental loophole rules. The first and probably most costly mistake that I see real estate investors make is misunderstanding how the STR loophole actually works. Most real estate investors know that to claim losses from rental properties, you need to qualify for the real estate professional status, or REPS for short. But the short-term rental loophole is different. You don't need to qualify for REPS to take losses against your W-2 or business income. However, there is a catch. Your short-term rental needs to have an average period of customer use of 7 days or less, and you must materially participate. And this means meeting one of the IRS's 7 tests. The 2 most common tests for short-term rental investors are the 100-hour rule, where you spend more than 100 hours managing your property and more time than anybody else. That means cleaners, repair folks, people like that. Next is the 500-hour rule, where you spend at least 500 hours on your property for the year. If you mess this up, the IRS will recategorize your short-term rental losses as passive, meaning you'll lose the ability to deduct them against your active income. So here's the fix. Track every hour you spend managing your short-term rental meticulously. We're talking about guest communication, maintenance, coordinating with cleaners, things of that nature. You want to make sure that you're tracking that time, and also make sure that you're tracking the time in some reasonable way of anybody else who's working on your property, especially if you're going to be using that 100-hour test. That is absolutely critical. Mistake number 2, hiring a property manager. Now, this one catches a lot of investors off guard. If you hire a property manager, the IRS assumes that you're not materially participating. And here's why it's a problem. The short-term rental loophole requires that you materially participate. And if your property manager is handling guest communication, maintenance, cleaning, and scheduling, you may not meet the 100-hour or 500-hour test. And if the IRS audits you, they'll say, sorry, but your losses are passive, meaning you'll lose the ability to deduct them against your W-2 or business income. So here's the fix. If you want to use the short-term rental loophole, you must be actively involved in running your short-term rental. That means handling bookings and guest communications yourself, coordinating cleaning and maintenance staff, and tracking all the time that you spent on the property. If you want to use a property manager, be very careful because you may very well lose your tax benefits. Mistake number 3, failing to track your time and other people's time. This is a huge mistake that can completely disqualify you from using the short-term rental loophole. Remember, if you're using the 100-hour test, you just don't need to spend more than 100 hours working on the property yourself, but you also need to prove that you spent more time than anybody else. And here's why it's a problem. Many investors forget to track the hours spent by their cleaners, maintenance workers, and other contractors. If your cleaner spends 120 hours on turnovers and you've only tracked 100 hours on guest communication, scheduling, and maintenance, well, guess what? You failed the test. And what does that mean? That means if you're ever audited by the IRS, the burden of proof is on you. If you can't prove that you spent more time than other people, you will lose. It's already happened to another taxpayer in the case of Lucero versus Commissioner. Here's the fix. Track every hour you spend personally on guest communication, cleaning coordination, maintenance, marketing, and more. Be sure to keep a time log in a spreadsheet or a time tracking app so you don't have to guess how many hours you had at the end of the year. Also, be sure to get estimates and invoices from cleaners and repair professionals so you know you're meeting the test. If you don't track both your time and other people's time, it could accidentally make your losses passive, losing all of your tax benefits. The 4th mistake, renting your short-term rental to your friends the wrong way. A lot of investors think, hey, I'll just let my bestie rent a place for the weekend at a steep discount and still claim the tax benefits. This is a big mistake. The IRS is very strict about the rules, and if you rent to your friends below fair market rent, it counts as a personal use day and not a rental. And too much personal use can cause you to lose your tax benefits. So here's the fix. If you rent to your friends, document the rent rate using comparable listings and keep payment records. Otherwise, it could ruin your entire tax strategy. Mistake number 5, too many personal use days. Here's another one that can land you in hot water. Personal use days include any time that you or your family members stay in the property unless you're performing repairs and maintenance on the property for a substantially full-time basis for the day. Why does this matter? If your personal use exceeds 14 days or 10% of the days rented, the IRS could classify as a personal residence, wiping out your ability to use the short-term rental loophole. So here's the fix. Separate work days and vacation days. If you're working on the property, keep detailed records, receipts, and logs to prove that it was for business. Also, one more pro tip here. If you swap properties with another short-term rental investor, say, hey, you stay in my property and I'll allow you to stay in mine, then that also counts as a personal use day. Mistake number 6 is simply failing to rent the property at all. Now, this might seem a little silly, but a lot of investors buy short-term rentals towards the end of the year and end up failing to get any guests to actually rent out the property. And this is a big mistake because in order to have an average period of customer use of 7 days or less, you need to actually have customers rent the property. This was discovered in a tax court case where the tax court determined that without any periods of customer use, it's impossible to determine the period of customer use. So be sure to rent your property out at least once, and it's often recommended to rent it out several times throughout the year to ensure that you actually can determine the average and you're running this as a real business and not just using it for the tax benefits. So please make sure to actually rent out your property in order to take advantage of this strategy. Finally, mistake number 7 is mixing long-term rentals and short-term rentals in the same building. So when you have a multi-unit property, the average period of customer use is actually determined on the building itself. And if you have a long-term rental, it's often going to push the average stay way above 7. Okay, so if you're going to have a multi-unit property, maybe a duplex or a triplex, you're going to want to make sure that you're renting out each unit as a short-term rental. Just one long-term rental can blow out this entire strategy and cause you to lose the tax benefits. So please make sure each unit is a short-term rental and has an average period of customer use of 7 days or less, so you don't lose out on your tax benefits. Now for the pro tip. Since 2024, the IRS has been ramping up audits on short-term rental investors who are abusing these rules. They're looking for people who cannot prove that they materially participated in their short-term rentals. This is why it's absolutely critical that you keep a time log of not only the time that you spend, but the time that other people have spent to make sure that you met these rules. Next, they're looking for people who are spending way too much personal time at their properties. Remember, people have beautiful vacation rentals and it can be very tempting to use them personally, but spend more than 14 days and you can lose your tax benefits. So make sure you're not abusing personal use of your property. They're also looking for people who have not had an average period of customer use of 7 days or less, and this can happen when you are actually not renting your property or you're renting your property, but it exceeds 7 days. Here's another bonus tip on the 7 days or less rule. It has to be 7 days or less, and that means 7.0000 days or less. If you are ever audited, the IRS will carry out, they will carry out the average use calculation beyond, it could be 7.1 or 7.0001, and you can lose your tax benefits. So remember, 7 days or less is 7 or less. So make sure you don't forget that. So those are some pro tips. If you do want to make sure that you are protected in the event of an audit, make sure you're following the steps. Make sure you have an average period of customer use of 7 days or less and can verify that. Make sure you have your time logs in order and make sure that you're not spending too much personal time at your property. So there you have it. Those are 7 critical short-term rental mistakes that could cost you thousands of dollars in tax savings. If you found this video helpful, hit that like button and subscribe for more real estate tax strategies. Now I want to hear from you. Have you used the short-term rental loophole? What's your biggest tax question? Drop me a comment and let me know. Also, if you're serious about optimizing your tax strategy, check out the link in the description to the video for a free 30-minute discovery call to see how we can help you optimize your taxes today. That's it for now, and I'll catch you in the next video.